The Hedgeless Horseman here. It's August the 5th, 2024. First of all, thanks to the sponsors. Very chaotic day today. Markets are broadly down a lot. I think Japan had its worst day in I don't know how long. I think that ended up minus 14% or something. Commodities taking a beating as well on the whole. I mean, copper has rebounded quite a bit. I think it was down 4%. Silver was probably down 5% or something. Still, it's been hit hard. I guess that's the one that's recouped the least amount of losses. I think that might have something to do with many base metal players basically seeing zinc and their primary commodities, let's say, get hit and immediately start to maybe sell silver futures contract, on the byproducts, try to secure, a pretty decent price. I mean, silver at 27. If we look at the average price over the last few years, it's decent actually. It's decent. I mean, it was down to what was it, $12 for a while. So this might be simply again not only, but it could be base metal players panicking a bit, seeing copper go down. I assume that zinc is also down. Not that much actually. Nickel is not down that much either. Platinum, palladium getting absolutely hammered, which is interesting. I mean, it is a small market, and the same is for silver. So it takes less money to drop those metals compared to gold and oil, etc. So it might be simply that there's like margin calls, or somebody needs to raise money and they're long in some of these smaller metals, and it just it's a hassle. Or who knows, maybe Russia decided, panicked as well a bit, and it's like, okay, we better sell even more platinum and palladium while we can, because things might be getting worse. As always, I don't know. I mean, we could bottom tomorrow. We could bottom a week from now. We could have a 2008-9 style crash. I absolutely have no idea, and that's the hardest thing there is, I think, to predict crashes and all that. I mean, people have been predicting crashes for the last, well, basically since 2008-9, and stock markets haven't really crashed. Yeah, we had the COVID flash crash. That was certainly a crash, but that actually ended up, I mean, recovering quite quickly. Let's look at Dow Jones, for example. And you hear that all the time, literally all the time. I mean, pay attention to this stuff. I was gonna say, as soon as this is 2008, 2009. I mean, it's kind of been a steady stare higher. Well, not super steady, but you get my point. And I swear, it's like every single one of these dips, everyone, including myself, especially since we're mostly gold bugs, at least people listening to this, so we're biased towards negativity in a way. We look at, since our, in our minds, the win condition is kind of for the rest of the financial market to go to shit. We seek out information that supports that, and that also sells and gives a lot of clicks and all that. So I don't remember exactly, but I'm pretty sure I expected the same thing. I mean, when this happened, broke a bunch of whatever lines, I'm pretty sure I also was like, oh, the end is coming right now. Well, that didn't last too long, and it kept going higher. Same thing here, broke some kind of resistance, probably felt like, oh, and I assume that the market might not be super cheap either. Recover that. This was actually a real flash crash, but that was over in what, 2 months maybe, and then maybe 3 months back to all-time highs and kept going. Same here. A lot of people expected this to be the start of the crash. My point is that everybody always expects it, and I hear the same thing over and over again. As soon as the market starts tanking a bit, and maybe it drives juniors with it a bit, but there's always an excuse not to buy low. And of course, you don't know that it's the bottom, at least at the time. But my point is, and we're seeing that now, and I feel that as well. It's like, you see a bunch of negative stuff out there, and it's like that's catering to your bias in a sense, but it's also catering, which is the weird thing, because in a way, if things go wrong out there in the financial markets, if we're biased towards like, okay, we're getting closer to the end game, meaning it's like, yes, the fiat bubble is going to collapse, the currencies are going to collapse, the government debts are going to collapse, the entire, everything that's propped up by low interest rates or have been, is going to collapse. I mean, that's basically why you have at least physical gold for. But the interesting thing, when that happens, it's also the schizophrenic nature of people in the gold space. More so maybe for gold miners or shareholders of gold miners, etc. It's like when the very thing that's leading to the end game potentially looks to be happening, and that happens a lot of time. This time here, this time here, this time here, this time here, and now again. People also switch to, it's like, oh, I've seen what happens when the markets crash. Juniors and paper gold can go down a lot. So it's kind of fun in a sense, like you're in it for the very idea that the stock markets, tech bubble, crypto bubble, it's like they're artificially or unsustainable in the long run. That's why you like gold and have gold. But when it actually starts to deflate, people panic because they saw in the flash crash of 2020 and the crash of 2008 that miners got kicked in the teeth. That's true and all, but it's like, okay, that happened once here in 2020, that's 4 years ago, and 2008, 2009. That's how long ago? A lot of years. 16 years ago. So twice basically where we've seen that in a major degree since the year 2000. So in 24 years we've seen that kind of happen twice. That's not often, obviously. Also, at those times, I mean, here gold miners had run up. Juniors had done okay. Here, juniors and gold miners had done really well up until this point. So they came down from quite high levels, quite high sentiment. There were a lot of weak hands that were holding these securities at both times, I would say, making it more likely that it's gonna have more of a cascading selling effect. And it's like today, I mean, how many institutions own gold juniors? I don't know many. Maybe some of the funds that are left, I mean, they're more like die hard. Because we've been shedding shareholders, we've been shedding institutional money, we've been shedding generalists, we've been shedding weak hands ever since 2011. So how many are there left to really sell? I mean, what is the makeup of the actual holders of most of these juniors? Do you think there's a lot of weak hands left in the junior space? I don't think so. How many are, it's like, who would one expect to be hit the hardest? Well, the low liquidity ones, and that's typically juniors, and the smaller they are, the lower liquidity they typically have, yes, one could expect them to get hit more easily. It's like one dude puts in a market sell order for whatever reason. Maybe he gets margin call and it's like the broker just sells whatever. Yes, That could happen, obviously. Otherwise, it's probably more where there's actual institutions that get fund redemptions and stuff like that. And again, that share of the junior sector has gone down. I think quite a lot since 2011. I don't know the exact numbers, but it's like you can tell. It's like there's been. I've seen some metrics actually. How much the active, let's say, precious metal funds have shed investors. That it used to be there used to be a bunch of different, the larger houses, brokers or whatever. They had actively managed mining funds. Many of them have shut down. So it's like, where are the necessary, redemptions going to come from? Who owns all these stocks that are going to see redemptions? And how strong are the hands of the people that actually hold some of these juniors right now? I mean, I'm not saying I don't expect there to be a pretty big crash in some juniors if we get a crash, but we don't even know what gold is gonna. We don't know what's gonna happen during a crash. Is it gonna be exactly like 2008, 2009? I don't think so. I mean, just from this dip alone. I mean, okay, it's not just this. It's that Japan fell, a record amount kind of in 2 days. But still, I mean, we're up here, and the Fed is already talking about emergency rate cuts. Here they were kind of late to the ball, if I remember correctly, or based on what I've read, and they have to do a bunch of financial shenanigans. I mean, later on they invented zero interest rates and negative interest rates. Well, that's already in the toolkit now, and it seems that the Fed and all that. I mean, everyone is much more sensitive to anything affecting the stock market today. So if you get what I mean, it's like in the, I don't know, in the old days maybe the stock market had to go, Dove had to fall all the way to here before somebody talked about doing something unconventional, let's say. I'm not saying that's the case, but that's how it feels at least. Now we've had this move, and again already talking about emergency rate cuts. It's crazy. I mean, imagine if we had that kind of support in the junior sector. Obviously it would be really, really hard to get real bargains in that case. Everybody would be cheering to have a backstopper in the form of Fed, as like lowered rates or printed money to buy up miners. But the flip side is you would never get fire sale prices. It would just keep them from getting cheap and just becoming more and more expensive, basically, setting itself up for a bigger bubble down the line. And that's absolutely what looks to be happening in the broader stock markets and crypto, etc. It's just not, the Fed is not allowing stuff to actually go, reverse to the mean and all of that. But my point is that the flash crash, you could have gone away on a 3, let's say when it really kicked off, it's like, a month, 2 month vacation. I don't remember exactly how quick the miners were to turn around. But it's like, not much happened. Yes, it was extremely volatile for a while, but then it turned around. It's like what I see. I mean, I see stuff like this all the time today. It's like no matter how low juniors are, they can still drop 90% from here, which is absolutely worthless information. Why? Because anything can drop 90% at any point in time. If it's near a top or near a bottom, if it's cheap, if it's expensive, theoretically anything can drop 90%. It just means that somebody has to sell it down. That's not the important thing. Because let's face it, if you are only gonna buy or hold anything when it can't go down 90%, you'll never buy a stock in your entire life. So I would flip this around. I would say, well, it's even not. It's actually even more rational. I could also say that juniors could go up 500% from here, because that's what they've typically done from levels like this. So the question, okay, and that's like, look at this is Endeavor Silver, so it's not a Well, I guess it's a junior producer. But I mean, it typically goes down 80%, then up, I mean, 400, 500 and all that. Now Endeavor has already rallied, which is the case with a lot of producers, whereas there's some, at least, institutional interest, and metal prices have been doing well. So it's not uh, too surprising to see, because gold is, in fact, near all-time highs. Silver has done well on average over the last 2 years or whatever, since we broke out of that bear flag. Bull flag, I mean, whatever you would like to call it. So it kind of makes sense. Sure, we're not down here anymore, but in the junior space, I would say we're close to being down here. Because it's the majors, or I would say the producers have done quite well. The mid tiers have done quite well. Look at Alamos Gold, look at Agnico Eagle. They're not at fire sale prices. I don't know what Agnico's PE is, but I doubt it's very low. So there is some sentiment in the producing companies. It's not rock bottom. In the junior space, it's rock bottom. So in the junior space, it would be more like a Bear Creek Mining or whatever, and that's sentiment is down absolutely in the toilet. So obviously the big risk is to the upside, because let's face it. What's the worst case scenario if you hold something cheap? You buy and hold something that is cheap. Your portfolio is made up of cheap stocks. What's the worst thing that could happen? One is that fundamentals deteriorate so much that after you bought, later on, value is actually gonna be lower than the price you paid. In that case, gravity is working against you. That means that that stock should drop to its intrinsic value. But let's say, assuming you have pretty robust cases, let's say you are focused on margin of safety. We know that gold in the ground might be selling for, I mean, depends on the stage and all that, but let's say $20 per ounce. And we know that during the highs, gold in the ground trades for like $100 an ounce. That's the big change. We're near the bottom level of the sentiment oscillation, let's say. It goes like this. Where is it? Goes like this, and juniors are still down here. Okay, so the next big change is up. So what should one be most focused on? That they can go down, and that happens all the time. During the flash crash, for example, let's say this was the intrinsic value of Endeavor. When price hit this level, it was already cheap. Then it got cheaper and cheaper and cheaper and cheaper and cheaper and extremely cheap. If you sold here, you have a very big problem. You sold at the lowest level since 2009. If you didn't sell and instead went on a 4-month vacation, you would be back already, and so, not long after that, the next 8 months or whatever, you would be up quite a bit. If you only started buying, let's say, here when it got cheap. That is not a problem. If you own something cheap, there's a chronic risk to the upside. You're waiting for gravity to work higher. If you own something expensive, it can go up and up and up and up. But sooner or later, I mean, you're on borrowed time. You owe money to the stock market because you've gotten paid too well. It's not actually worth this much, especially in a cyclical sector as well, since we know prices of the metals are going to have a correction sooner or later, and the value is going to go down. So you're on borrowed time here to the downside, but down here you're on the stock market owes you money. So if the biggest problem we have is that we can have a bigger paper loss for a short period of time, that is a luxury problem to have. I would be scared to death if I had crypto, if I owned Nvidia or any high flyer tech stock which is trading, pricing in a future that is much better than the current picture. It's like, the let's say the earnings of this year or the last quarterly earning. If they're pricing in a growth pace or whatever, that means the stock is pricing in that things are just going to get better and better for the next 5 years, let's say. You're taking a speculative premium. That's a speculative risk. That's also why it's like silver miners, I don't find them too cheap. I don't find gold producers, gold miners, that cheap either, especially not the large ones. Adriatic, I think, is having some problems, but it's like Andean, okay. I guess this is all in sustaining, well, yeah, break even cost, like $25.25. Silver is at $27. So if these cost estimates are correct, silver needs to fall like $2 for these to kind of be break even, meaning you're not returning anything really. So at face value, it's kind of worthless. I mean, the business produces gold and silver, but everything goes to salaries and cost inputs. Same for core. Endeavor Silver would actually be producing at a loss already. Is that a lot of margin of safety? Then you can see why it's like, take Endeavor Silver. If silver drops $2, according to this, Endeavor Silver would start to bring up ounces in the ground that they are making a loss at, would have negative earnings. Then you can understand why this is so volatile. Like a $2 drop in silver, that's not really unheard of. All of a sudden, that business is worthless at face value at that point in time. So how much is that worth? A business that you're losing money on? Well, technically, at face value, it's worthless. It's worthless. Is there a lot of margin of safety here? I don't think so. And it also depends. I mean, Fresnillo might have more margin of safety. It's like it will take more for silver to drop for Fresnillo to be a money-losing operation, money-losing business. But it might be priced very high already. Maybe it's pricing in $30 silver. Maybe you're already paying for a silver price that's not here yet. So you're taking a speculative premium on a future silver price that ought to be higher. So in order to actually make more money, really, if we're excluding the fact that something can go to an even higher PE and price in an even more bullish future, you need silver to go over 30 for that investment to make sense, which is not the reality right now. And in that case, you're actually overpaying for Fresnillo. But it does have more cushion to the downside. Not that you're buying it cheap, it just has more cushion before it turns into a cash-losing business. So that's the thing. You can't look at these only. I mean, let's say Endeavor was down here now, and they were making some profits. It's like maybe that would be an okay bet, because silver might only, I mean, it was kind of pricing in that it was probably, silver prices were probably going to go down below 26, for example, and stay there for a while. I mean, it's hard to. This is why investing is an art. I mean, you're dealing with expectations and probabilities and all that. My point is, I don't think any of these have huge margin. Well, maybe Gatto Silver, Adriatic, if they make it work and all that. But we don't see the actual valuations. We just see the break-even costs here. So then you kind of again have to figure out. I mean, there might be a case where yes, silver is at $27. It's pricing in, some of these are very cheap, let's say, or lowly valued. Where it's like there's huge torque to the upside if they don't go down to break even, or they don't stay down at break even or lower for a long period of time. It's already pricing in a very bad scenario. Whereas again, the ones that have pretty good margin of safety, where silver could drop like $12 before they actually start losing money, that could already be priced in. Everybody loves, let's say, Gato silver so much already that PE at current silver prices is like 50 or something. So it's like, yes, technically you have cushion to the downside. There's margin of safety from an operational standpoint. But you're already paying for a silver price that's higher than it is. So technically at face value, you're not buying something cheap. You're already buying something that is expected to you're buying a future where the silver price is higher. So in order for this to look cheap, silver price needs to go even beyond that. That to me is not a very convincing risk reward. Except if you only play the fact that, hey, Gatos is a fan favorite, or First Majestic, for example. I mean, it's literally at almost at break-even costs. So if at face value, if the silver price drops $1, First Majestic is a money-losing business. But it's the most. I think it's the favorite of silver speculators. Pretty high market cap. A lot of people know about it. A lot of people see Keith Neumeyer talking about $100 silver. So it's been a fan favorite for a long time. But that also means that, in my opinion, it's almost never been cheap. It's pretty much not been a good business for the last 10 years, if I'm not mistaken. It would be interesting to see how much they actually earn. For an investor standpoint, I wouldn't touch First Majestic silver. If you're a pure sentiment trader, First Majestic might make a lot of sense. And right now it's down to around break-even cost, where a $1 swing in silver could make it going from a cash flow positive business to a cash flow negative business, which is obviously huge. It goes from being worth something to being worth less, and then they can switch back again. Silver goes up, all of a sudden you go from a worthless business to a business that's worth something. That's obviously huge, and that's why these juniors, especially the higher cost ones, they swing like crazy. They get priced like they have a worthless business, or almost have a worthless business, that they're probably gonna go into bankruptcy. Then silver prices go up, all of a sudden they have a cash flowing business. So it goes from almost 60% of a worthless business, probability of a worthless business, to a cash flowing business. And that has just huge impact. A company that's worth nothing, let's say, to a company that's worth maybe quite a bit at those silver prices of the day. But typically these always overshoot, because the momentum traders and retail, well, everybody's almost a momentum trade, they get in and up at the levels here. I don't remember what silver was, maybe 32. I bet Endeavor silver was expensive compared to the current silver price, if I had to bet. So it might have been pricing a $35 silver. Then silver prices hit $12 and they were losing money again. And you have these 72, during a flash crash, down 80%. So one thing I think is like, understand the market. Why does this volatility happen? And what is more important, what is good risk reward? To me, this is not good risk reward. To me, most silver producers, except for maybe Adriatic, but they have other problems. Maybe Gato Silver, but do they have growth? What silver price is priced in? Is it already, does it get such a high premium? It's the same with, the Franco Nevadas or whatever. The ones that have kind of delivered and are assumed safe, they also traded typically, ridiculous PE levels. So even the best companies in the world might not be good buys, because there's no real upside left. It's pricing in a great present and a glorious future. I have a hard time seeing there's a lot of. I wouldn't consider almost any one of these to have probably free optionality. I could be wrong. That's the thing. I could be wrong. Maybe some of these are priced like, a fair price. Let's say Aya Gold and Silver might have a fair price. I mean, it has some cushion to the downside. Silver needs to drop to $19 before it starts getting, to eat into their cash balance, etc. Maybe they have a fair value based on the current operations and the probabilities of silver going to 19, but they also have a lot of exploration potential. Then there might be some kind of almost free optionality. But that again could change because all of these are operating companies. That's the problem. So it's very hard to have that kind of free optionality because they can go bankrupt if things turn out really bad. But as we kind of see, most flash crashes have been. This is the though. Yeah, I mean most crashes is like, yeah, the big one was like 2008, and this one only lasted for a few months, and now nobody's in the junior space especially anymore. So it's like I don't get it. What does this? What does this? Which is a fact, but it's a worthless fact. Do you think this guy was buying? I wasn't buying Endeavor, but it's like, do you think this guy was buying? The lows anywhere close to the lows? Oh, obviously not, in my opinion, because he seems to, most tweets I see from him is talking about how crap this sector is and it can always go lower. Does that sound like someone that has value? Price is one thing and value is another. That doesn't sound like a value investor. That sounds like something which is for most people. Their main fear is a price decline. I don't fear price declines. I fear buying something and I'm wrong on the fundamentals. If I think something is worth 200 million, it's trading for 70 million, and I'm wrong about the value of 200 million. If the actual value is 50 million, I overpaid for something, and I should be afraid that the mean reversion, the reversion to fair value is actually lower. So I should expect to lose money on that investment because I was wrong on appreciating fundamentals. That is the only risk as a value investor. But you don't see anyone really talking like that. Everybody's afraid of a price decline. I'm constantly afraid of price declines in a sense. It's like now, it feels like the world could end at any moment. That's how today feels. But if I let that dictate my investing strategy, then I might as well pack up because I have no business pretending to be a value investor in a volatile sector if the overriding fear or the main focus is, do I think this could go down in price soon? Because that happens all the time, and especially obviously at bottoms after crashes, at low valuations. So you're gonna be biased for a crash or lower levels, the lower they are. When as a value investor, you would see it as already a no-brainer buy. So this, and that's also, I'm gonna get to that. It's like, what have I done on Twitter, for example, today? I've been memeing a lot. I do a lot of memes, especially on volatile days. I bring out, kind of the idea is that I try to get people to snap out of it because the whole Twitter sphere is talking about doom and again that prices might fall. Again, you see a lot of these tweets. You never see these tweets or responses on updates typically. You can again pay attention to how people work. Do you see a lot of warning signs that hey, they can drop 90% from here if gold is going up 3%, silver is up 5%, everything is ripping? Do you see a lot of people cautioning other people as like, hey, they might fall 90%? Maybe someone who hasn't, bought in and feels like he's, missing out. Maybe. But most of the time you see the warnings that it could go down in price comes after it has gone down in price. Or people expecting to go down in price, etc. So he's not doing himself any favors by keep focusing on something that nobody has any control over. The only thing we can control is what price we pay for anything. Because the market, Mr. Market gives us a quoted price of a security at every given moment. We can choose to buy or sell or hold. That's the only thing we can control. We can control what we do at a particular price. We can control what we pay for something. That's it. What we also know is that sentiment always changes. Those are the only two fixed points in especially a cyclical sector. The only two things we know. Price is, we know the price at any given point because Mr. Market gives us a price. And we know that sentiment always changes. Everything else, like fundamentals and stuff, that's something that nobody knows for sure, and we have to make educated probabilities. And as soon as the expected value of these, low to medium to high risk securities, if we find the value to be higher, then it's a buy, regardless of how bad the chart looks, regardless of what people on Twitter says, regardless of what the Fed is about to do, regardless of everything like that. If it's cheap, it's a buy by definition. If things deteriorate, that meaning gold goes down to 1800. Yes, that means if we pay, assuming a $2,000 gold price being priced into a gold unit, for example, that's what we think it's pricing in, and it goes down to 1800. Yes, in hindsight, or in that future, we would have actually overpaid for that future. But that future is unknowable, and at the time gold was, let's say, 2,400, so we bought cheap. And we had quite a wide margin. We had to see gold go down $400 before we got to fair value for what we paid. Then it has to go lower. And if stuff gets really, really cheap, whatever, then we can value shuffle, then we can put in more money. Nothing helps a portfolio more than putting more money when things are cheap. It's like I said about, a portfolio I have for a family member. Had one stock, down one junior, because it was so little money, so I could really only buy one junior. Went down 90%. I made him put in a bit more money. Even though the portfolio is down, I think around 75% or something still. Last I checked, he was in the green. He had made money on that portfolio. Not a lot, but just thanks to, okay, you lose on the things you held. You add a bit more money when the expected future returns are much higher. All of a sudden, you have a return on your investments. So I meme to, again, make people snap out of it, not to take everything so seriously. And show that while 95% of people are running around out there with their hair on fire, talking about, everything can go a lot lower, everything can go a lot lower, we're gonna have a crash. I'm trying to show that I don't care about it. When everybody's talking about doomsday, letting their emotions run amok, I flip the script and basically make fun of the market. Talk about, the lovely bargains, or that, hey, this is not enough to shake us out of holding our cheap stocks, because, like, again, we're in the very sector that's basically the only thing, one of few things that actually goes up in value when everything else crashes. It might not do it immediately. Paper gold might go down and all of that. The first reaction. But if things go really, really bad, gold is probably the thing that's going to lose the least amount of purchasing power. So again, we're kind of schizophrenic. That's like the stuff that we've been fearing. That's why we have gold. When it's actually happening, people turn to fearing what they've been waiting for happening, because like, oh, I might have paper losses in the short term. Like I told someone, maybe it was him. If juniors, let's say, you buy some juniors at, let's say you have some, pretty decent developers, let's say they're trading for 20, 25, $30 per ounce. Meanwhile, the discovery cost of ounces might be $70, $80 per ounce. So you're buying, on the cheap. Let's say the stock prices, not the value, the stock prices go down 80% from here. Let's say you're already down 50% even with this run up, and it goes down 80% more. I haven't done the calculations, but let's say your portfolio is down a lot. From these levels, I expect many of the higher quality juniors to return 300 to 500%, more than that if the cases are intact and we go into a real bull market. If they drop 80% from these levels in price for a short while, I would expect, I don't know. Oh, this is gold, right? These aren't miners. I could see some going up 3,000% from those levels, those lower lows. That's why I don't fear a price decline. That's why I meme, and I don't want people. And okay, again, this is how I invest. It's probably not for everyone, but that's how I made my money, and that's how I expect to continue to make make money. No market timing, only price versus value, only value investing, and then just own the stuff that I think is the cheapest with the best risk reward. Because let's face it, I mean, if some of these juniors, again, let's say they're pricing in, you're buying in for 30, depending on the quality, of course, 30 to $50 per ounce. Let's say 50. Let's say they trade down to like $10 per ounce. That's gonna hit $100 sometime in the future, regardless that it went from $50 per ounce to $10 per ounce. Because that's what this sector always does. And you can only imagine, I mean, the larger gold producers are making good money now. Let's say some shit happens and gold goes to 3,000-4,000. I don't know what the gold in the ground could be valued at. I wouldn't be surprised one day that we actually saw like $200 per ounce or something. That would be a 20 bagger in that case from the lower level. So then you have like, almost 2,000%. That's why I don't fear a crash, because I know it's going to be temporary. Because the gold mining sector is not going away. Are there problems where some juniors go down and there's absolutely no access to capital? They have shitty backers. They don't have any money. They have high costs. They have liabilities. Yes, but that's for us as stock pickers to evaluate. How long can these juniors survive? There's some that are free carried by a major, so they can just close up shop, and if they have high insider ownership, they're gonna probably do exactly that. Meaning not do much, maybe not even take salaries, but they get to keep the project, and maybe the project actually gets work because the majors are still making a lot of money. Because the majors' earnings are not tied to the sentiment of the junior sector. Or you have a company with a lot of cash. That's why when I see people complain, well, this sector only dilutes, etc. Oh, you can't make money on juniors because they all dilute. No. You can make conscious decisions trying to find the ones that are probably not going to dilute as much. I mean, if you really take the high risk route, then we're talking like pure exploration or high margin producers. Then you have real risk of them not finding anything of value, and whatever price you paid might look too high in the future. Or again, you have a high margin producer, metal prices fall, and they have fixed costs, and they could risk going bankrupt. If you own those, you can't go and like throw up your hands and it's like, oh, it's not my fault. It's the market. You can't make money in these juniors. I mean, that's bullshit. You know, live by the sword, die by the sword. If you want, I'm not expecting my portfolio to have the best absolute returns in a. If the bull market or the real bull market started tomorrow, and we went up for 2 years, I don't expect my portfolio to be the best performing portfolio. Because I don't have the highest risk juniors out there, or the high margin producers, for example, which if silver went to 50, one of these might go up, I don't know, 800%. I'm just guessing here. Whereas my portfolio might go up 400%. So I get kicked, or I underperformed that portfolio. But I might have a much safer portfolio. That if the real bull is a year away from now, I'm pretty sure all my juniors are going to be around. Some might actually have added value. Some might not even have diluted much because they might have, carried interest, or they might to get into low, high, decent margin, free cash flow operation, etc. So this idea of like just throwing up your hands and saying, oh, the sector and what, as soon as you complain, it's like, what does that signal? That signals that you don't know what you're doing. It signals that you're waiting for someone to save you, basically. What's the other explanation? If you sit on Twitter and bitching about, juniors and whatever, it's like, oh, they suck, and it's like they do this and all that. It's like, nobody cares. Work harder. I don't know how many thousands of hours I have, just been thinking about investing. Probably more. It's like that's what I've been dedicating the last 8 years to. Getting better and better and better. And I still think I'm getting better and better and better because I obsess about this stuff. What's risk reward, and being comfortable with the fact I'm not going to have the best performing portfolio. But I would be much happier to have a strategy that works long term, even though, like always, the portfolio is gonna go like this because I can't predict the sentiment swings. I can't predict the surprises, both negative and positive, especially if it's drill plays or whatever. But the trend is up. Instead of like having a portfolio very high risk, you tank. Let's say you really tank. You bought a lot of shit cows, and you don't do anything about it. It's like you're down 70%. You don't even want to do any due diligence. You just think the market owes you whatever. You listen to, silver's gonna go to 50, gold is gonna go to 3,000. You're like, yeah, I'm just crossing my fingers and hoping to get bailed out. So you're not proactive at all. You don't know what you're doing. You probably hold a lot of, let's say, high risk crap cows, or stuff that's close to maybe go bankrupt. So it's like, then you're playing with fire, because then obviously the sentiment has to turn around before your crapco has diluted away every upside, or the high cost, high margin, low margin producers go bankrupt. And that's why I keep saying it's like, no, I mean, I adjust things. Okay, gold prices are very high. The business is flourishing. The discovery cost of ounces is this. Okay, then I need to see a pretty friggin' convincing exploration play before for me to sell proven ounces, proven success to buy that. And I can buy ounces in the ground probably cheaper than the average ounce is to find. Does it make sense to buy a lot of, especially pre-discovery plays? They don't even have margin of safety. One other thing to note is like, I see stuff like this today, for example. He's a quite famous Swedish investor, a retail investor. Well, he's a private investor at least. I would say quite a good one, I think. He tends to have a concentrated portfolio and all that, and obviously the generalists, they have had a bull market for the last 10 years or something, so you can't really, like I think I mentioned here, yeah, okay, we'll get to that. Well, I can do this first. So I tweeted, seeing some generalist retail brag about having experienced and survived the 2008 crash. Meanwhile, what mining speculators had to go through in the same time frame. So their last memory of something really bad, a real bear market, was 2008, which we see here, 2008. That's the last big crash, the real test that the generalists really can remember. Because after that, as you can see, I mean, these are some pretty, decent declines and all that, but it's not like 80% or anything. Since then, it's been a bear market for, let's say, 15 years. And again, you see people shitting their pants after this. It's like, whoa, we would kill to be that, have that luxury problem. Oh, we're down, whatever, 20% from all-time highs. Meanwhile, again, meanwhile, what mining speculators had to go through in the same time frame. So this is Hecla. I mean, it used to be, I think, at least a high margin producer. I don't really know what the margins are right now. Hecla 19. I mean, that's actually quite decent. Anyway, minus 92, minus 87, minus 84. Just this little one here, minus 61, minus 64. So where these guys brag about surviving 2008-9 bear market, junior speculators or investors, however you want to see them as, have suffered through basically 5, not 1. That's why I've also said, it's like, if you can beat the junior mining sector, because nothing teaches you more about sentiment than the gold junior sector, or silver junior sector for that matter, or any cyclical commodity. Well, you have cyclicality, and then you also have sentiment, because again, the cyclicality of gold has led it to an all-time high, but the sentiment is not at an all-time high, so it doesn't even need to match. But it's going to teach you, I think, if you make this work, if you survive in this sector, I can't see how you cannot make money kind of forever, in a sense. Because this, in my opinion, is the absolute hardest sector emotionally. And contrary to Bitcoin and crap, there's no margin of safety there. So it's just a pure casino, a trading sardine. So you don't even have to do any due diligence to follow. You can't even, it's like, oh, I estimate the value of Bitcoin is this, so I'm gonna try to be a value investor who goes down. No, it's just pure speculation. So it doesn't really count. It's just pure greed all the way through. It's like just pure greed, which is kind of funny. Well, switching from fear to greed and all that, but you get it. But that's interesting. And some, were here during the crash in 1987. But this actually is inspiring to me in a sense, because this tells me that the generalist investor is proud of having survived, and I think the better ones, they actually bought the lows here. The value investors, the Warren Buffetts, let's say, or retail investors, they actually bought the low, and obviously this from these levels, their returns were absolutely the highest. From here to today, that's 174% over 15 years. And you can see the returns go up. But still, imagine, this is also why there's no more opportunity than in a volatile sector. So the lowest price point, and that's in 2008, in Dow Jones returned 487. And you can look how many times we've had rallies like that. $1,200%, 443, similar here, almost similar here. So that's also an interesting thing. That's like, the more volatile a sector is, the more you can make money. But that's only if you buy low. That's only if you buy low. So there is no sector that is harder mentally, on a psychological basis, than the junior sector, but there is none more profitable, in my opinion, than a volatile sector if you actually figure out how to beat it. So it's like the price of figuring out a volatile sector, the price, the end price, if you do it, if you put in the time and have your emotions in check, it cannot be beaten. Doing stuff like this basically means he probably doesn't have a chance, because he's still looking at the downside risks when you should be thinking about the upside risks. So that's a tell basically that he does not understand how you make money in a cyclical sector when sentiment is king. And like I point out here, one sector at a top 20-year valuations, another at a bottom 20-year valuations. I'm talking about tech. One should fear gravity. It's like it's almost like people are more scared in the junior gold mining sector. I'm primarily using the gold junior sector because it's, in my opinion, the one with the highest margin of safety, because again, gold is at 2400, so you don't have to take a lot of risk. When I started buying during the 2015 bottom, gold was down to $1,100, actually down to $1,050, and I bought stuff that was on paper worthless. So I, by definition, was taking a speculative premium that the gold price would turn around, and these at face value at the time worthless projects would actually fetch value sometimes. So that was, in a sense, pure contrarianism. Not even value investing in that sense, because I wasn't buying stuff that actually had value. I just bought them very low, so it was more of a contrarian beta streak. I just bought as many silver ounces as I could. Bear Creek Mining, Great Panther Silver, and Avino, I think, and Endeavor for a while. First Majestic and stuff, and that worked out really well. Because again, at that point, especially in the developers and producers, most of them had no value at the time. If you assume the prevailing metal prices. Now we have the luxury of having gold at $2,450. We have plenty of margin of safety. This should be a walk in the park for any value investor. Then that's obviously why you see the Pierre Lassans, the Frank Gustras, Sprott is getting in. What did I say, Ross Beatty? You hear the billionaires talk about them never seen anything like it. They're buying. You can see a lot of, search, Frank Gustra and I mean, some of them aren't getting that much into junior miners, I guess, because they're nearing, retirement. And Eric Sprott is pretty much all in already, I would think. But look at Frank Gustra, listen to Pierre Lasson, listen to Rick Rule. I mean, that's basically what he's been focusing on lately. Like he did with uranium when it was really cheap, and he says the easy gains have already been made. I don't think he believes that with gold and silver, because I see him popping up in quite a few private placements. So you can just follow the smart money that have made billions doing this. And that's what they're doing, they're buying. So again, if you can't see that, and if you're worrying more about the price decline, even Rick Rule said that. It's like, in a relatively recent interview, he said, don't buy a single junior, even though they're cheap, unless you can come to terms with the fact that they're probably going to go down 30% before they go up. And, the more higher risk, you can expect more than that. I mean, I wouldn't be too shocked if I saw 50% declines in some juniors. What he means is that the final destination is going to be a lot higher. But before that final destination comes, we might have a flush in the share price. Just the price, not the value, but the price. Things could happen that you should assume that you should see a 30% decline before you make any money. So this is obviously very exaggerated. They can still drop 90%. Again, he's just scaring himself out to buying low. And, to me, that's an obvious mistake. But yeah, so that's why, why I meme a lot and talk. I actually enjoy it. I take that as positive feedback, because it says to me when I can be cheerful, it's like I've been making jokes today with friends about, the market and all that. Even though it's like, yeah, come tomorrow, the Canadian markets might be down. We might have the rest of the markets crashing tomorrow. But it's like, when everyone is fearful, if I can be, cheerful, and again, just focus on one thing, what the value is, what the price is. If price goes down and value doesn't go down, it just becomes something cheap just became cheaper, meaning that my big returns are postponed. That's all it means. It doesn't mean I'm not going to make money on it. It just means higher paper loss in the meantime before I make a lot of money. That's not really a problem. A problem is, again, if you overpaid for something where it's just a matter of time before you're going to lose a lot of money. If it's just a matter of time before your portfolio actually appreciates several hundreds of percent, you don't really have a problem unless you can't wait for it. Unless you have patience. So in that case, that's patience. The lack of patience would kill you in that case. But yeah, so it's mostly to snap people out of it, to like not pretend that everything should just go the way we hope all the time. And I mean, the thing is, when volatility hits, I'm licking my lips, because I'm constantly on volatile days, especially if something is already cheap, on volatile days to the downside, that means somebody or a lot of people are making mistakes. If something is worth this much, selling for this much, this is the expected future profit, and a volatile day comes and it goes like that. That's a massive opportunity. Maybe a 20% decline might mean 60% higher future returns if I can value shuffle or can put in some money, and maybe it was already very high future returns from this level. So believe me, I'm gonna be, I'm gonna be watching the market tomorrow when Canada trades again. Because if I see some of the higher quality stuff drop 20% just because the markets are melting down, I might do some value shuffling. That happens now and then where it's like something goes really crazy. Because again, in my opinion, there's some stuff out there that if they go down 30% from these levels, I expect to make 500 to 1,000% on them. This is not a time to be fearful. This is not a time to be a scaredy cat. This is a time to have a very good grasp of what you think the value is, and then just watch the price levels. Maybe some stocks you own, they won't go down that much. One of your favorite stocks drops 20-25% because somebody needed to sell. Somebody got scared, whatever. Boom. Instant opportunity for value shuffling. And that's not going to show up in the short term, obviously, again, because if you own just 3 stocks, 2 are neutral, 1 goes down. That means your portfolio goes down. If you sell some of the others without price changing, and you buy some of the other, your portfolio value doesn't change for the day. Your future portfolio value might go up by 10% just from that value shuffling. So it doesn't show skill, price to value, all of that shows up in the long term on a rolling, let's say 3-year basis or whatever. Skill only shows up over time. Opportunities seized does not show up in the present. They show up over time. So you need to know what the right thing is to do today. The reward is going to come in the future, not today when you make the good decisions. It's delayed gratification. Was there anything more? Oh yeah, just a final maybe note here. Jesus, I'm already up to an hour or whatever. Just a last thing. This was actually what I was supposed to talk the most about. Like, what is, as Pierre Lauzon says, free optionality? As he said, you give me free optionality and I'll make you a millionaire. So what's free optionality? I talked about this last video. Free option, I think it was last or second last. Free optionality is when you have upside potential that you're not paying for. It means risk-free upside potential. And a hybrid play, I mean, you can have a few different versions of this. This black line is the price we're paying today, let's say. This is a gold developer. Let's say you have expected future returns of 200%. You think it's worth 200% more. You could have one where it's like very deep value play, where it's like, oh, you expected to be at 400%, but maybe no potential after that. It's a very mature project and all that. So this is at least a very fat bird in the hand. You expect sooner or later you're going to cross price is going to cross fair value unless value goes down. So that's your bird in the hand returns, but no bird in the bush returns. But if you have a hybrid play that's like, yeah, it's pretty, it's pretty cheap. It might be, you might have 200% as you see. It's like fair value is 200% higher. It's just a matter of time waiting for the sentiment, which nobody knows when it's going to turn. This is going to reach fair value one day. So that's just waiting for it to happen. Might take 6 months, might take a year, might take 2 years. But you're going to get around 200% on average in identical cases. But then it also has the free optionality. Some exploration potential, maybe a free carried project, maybe secondary assets that looks, they should be able to monetize. But since you're not paying even full price for the main asset, this is pure free optionality. In the case of what I guess Pierre Lassonde means when he's talking about royalty is that he's paying fair value for the current operation and he's going to get his money back in time. But then he has a free optionality that he's not paying for of any additional ounces discovered by the company, and he's not paying for the exploration. So he's paying fair value for what is proven, for what is ongoing, the ounces that have been found already. But he makes the risk-free upside on the potential. Any ounces that are going to be found in the rest of the 98% of the land package. And he says, if you give him enough such cases, he's going to make you a millionaire. I'm not doing royalty deals personally myself, and I don't go into royalty companies. I think they're just too boring, even though they might be the safest, and maybe it's an easy 1-200% or whatever, but not. And of course, I mean, if they have good royalties, that means that they also have free optionality. But in a sense, they're just too boring for me. But I have juniors that I think the margin of safety is around here. And stuff can happen, believe me, anything could happen. But if there's pretty good upside to, like, yeah, what I can see the base case value is, it's like, I think this is going to hit this level just from a change in sentiment, unless they mess things up. Then it's like, this is the bird in the hand returns. Let's pretend that's 200%. Just going to matter of when. But then they have maybe a lot of potential. If I pick 20 such juniors, above average quality, there's no way I'm going to lose money in the mining sector. There's no way. Because if I'm going to lose money, given what the probable upside is plus the free potential upside, I must have some insane bad luck, be very off on the margin of safety and potential, and or a bunch of other stuff. And that's going to have to happen for majority of plays. Because if I think every individual play has a probable 200% when upside, and maybe a 500% if upside, I don't need many, I need less than half of them to actually pay out the bird in the hand, the sentiment, expected sentiment returns, and none of the potential free additional potential needs to happen for me to actually make money. If half, deliver on what I think is the margin of safety, and I'm quite correct in that. So half of them actually do have a margin of safety or a fair value that's on par with what I thought, and they do end up going up 200% within 2 years. Half of them only. I'm wrong about the other ones. And some of them deliver on the potential as well. So some not go up 200%, some go up 400-600%. Then I'm going to make money again. Again, going back to the old Sun Tzu saying, put yourself in a position where it's impossible to lose. And you can't do that on an individual case-by-case basis. Even Franco-Nevada had its the mine in where was it? What's the name? Panama. The big copper mine in Panama belonged to First Quantum. That was supposed to be a bird in the hand, right? That went away. Stuff can happen. That is why you diversify. Because you cannot foresee Red Pine CEO allegedly mixed with the assay results. And that actually didn't totally destroy the value anyway. So it's like, I mean, but it hurt. And it was a shakeup in price. First Quantum getting their mine nationalized, that's very hard to predict. Victoria Gold having their heap leach pad collapse, and maybe the company might go bankrupt. Those are black swan events. If you bet everything on the best risk reward case you have, there still is a chance there might be a black swan event. Because you don't know how the leach pad, you're not a mining engineer. I'm not an expert on Pan American politics. I'm not privy to the chain of command of the assays coming from Red Pine. But on balance, there's no way every 20, if even half, if I'm right on my due diligence, if even half have black swan stuff happening, and I'm right on half of them and some deliver the free optionality on top of the margin of safety, I'm gonna make money. But if I'm all into shitco's that dilute like hell, they don't know what success looks like, they don't even have a good project, 50% of the money goes to salaries. If I have high margin silver producers that could risk going bankrupt if silver goes down $3 or whatever and stays there for a long time, yada yada yada. Do I really have the risk reward in my favor? Is it a matter of when, not if, then I'm actually gonna make? No, I would say it's a matter of if in that case. That is too much speculation. So again, I go back to the fact that you can't just throw up your hands in the air and just do the lazy approach like, well, people say silver's gonna go to whatever price and gold, and you have no idea what you own, so you get scared shitless anytime the market volatility comes, because again, you're just waiting for silver to go to $50. So when it goes from $29 to $27, you have no idea what's happening, because you thought it was going to be a straight shot to $50 and easy street, sipping pina coladas down at the beach. Does that sound like smart investing? Does that require patience, due diligence, keeping your emotions in check? No, you might as well bet on Bitcoin in that case. Maybe that's actually even a better speculation in a sense. No, I don't think so, but you get my point. It's up to us. The more quality input, the better quality output. And we should expect, the more we learn that we might, let's say these are expected return lines. This is the first year we go into this sector. Here is 0. This is what we expect to make over the long term. We start out like shit investors, don't know what to do. We bet everything on crap plays. We bet everything on one drill campaign pre-discovery plays because we want to get a 10-bagger tomorrow. Then we're starting off with an expected average annual return of maybe, I don't know, -30. It's like just a matter of time before we actually are done and dusted because our investing theory sucks. and we can't execute anything. We take the wrong risks, and for the bad type of rewards doesn't add up. We learn a bit more. We read up more about. We consider concepts like what is margin of safety, what is free optionality, how important is management, how do I capture management alpha? Well, that's time holding a stock, because the more time you give a good management team, the more value they should have created. So at price X today, if we wait 3 years, we expect them to have made more value in 3 years than in 1 year. So we expect to be up more, or the probability, even accounting for sentiment swings, we expect to be at least neutral or probably up. In a good market, we would be up a lot. Okay, that's a way to play the management, high quality management, obviously. Time held. Okay, that's simple enough. And yeah, just do the basics. Stop picking shit companies. Have some sense of value. Have some sense of what the margin of safety is. It's like take line one for example. Is the exploration potential of line one, is that free optionality? I wouldn't say it's free optionality right now. The mine needs to work. If we go through that hurdle and they get free cash flowing, and they make maybe good cash actually, they go down to the 500 zone and we actually make multiples of the current market cap, let's say. I'm not saying that's going to happen, but it's like, well, if they're making free cash flow and they explore and it's like, oh, we have a 10-year mine life, whatever, we have a pretty decent cash flow, we can use that to explore. Yeah, on an ongoing basis, one could say that all the exploration potential in that case is free optionality. It's like if they go into production, it goes up to 150 million or 200 million. We expect, hey, before this is done, I think they will have earned 400 million from what's kind of known at Tuvatu, for example. Well, okay, then you have a believable margin of safety of like 100% higher, and all the exploration potential comes for free. It's like, oh, they add another year of production. Well, that's 30 million extra. Another year, 30 million more, etc. But right now, is the exploration potential free optionality? I wouldn't say so. And another way to look at it is like, okay, Snowline, for example, which I took a big bet on during the early discovery phase of the Valley deposit. People were saying, oh, it's so remote, they're never gonna. Well, some people said it doesn't matter what they find; it's so remote that it's gonna be worthless. It's like, I don't know when Valley is gonna go into production, but my thesis at the time is like, the market is not gonna care about that if they start pulling out 200-300 meter holes of like 2 grams per ton. Because then it's going to be a pure exploration play. It's like what you kind of opposite what you see in Lion 1. As soon as they started to go into development, that's what the market saw them as. So when exploration results came, the market didn't really care. Because let's say it was not fantastic enough that it was going to change the fact that that it's going to be acquired like that, let's say. Because the market believe, okay, they're going to go into production, and that's obviously fraught with risk, as we've seen in the gold space. So that took over. So in a sense, it's like I actually held it for, the exploration potential, and that's why I also hold it today, because I hope they're going to get into production. But it's like, my point is, it's an art. It's like, what risk is actionable and relevant right now? It's the same for these high margin producers, let's say. Let's say you think First Majestic or Endeavor, someone that doesn't have the access to capital like First Majestic, perhaps. Let's say Endeavor Silver. Oh, they have 2 projects, like early stage projects with a lot of potential. Silver hits $24. Are they going to be spending a lot on exploration? Maybe they do. Try to make a discovery and bail themselves out. But that doesn't change the fact that they're bleeding cash. So all of a sudden, the exploration is not free optionality. All of a sudden, their entire mine is their entire business is dilutive by definition, since they're losing cash. And even if they, in the case they actually want to drill said deposits, they will need to raise even more. Or if they have a cash reserve, I guess that brings some buffer. But I hope you get my points. Like every single case is different. But if we can find the best of margin of safeties with the free potential, have 20 set juniors, I mean, you're not gonna lose. Keep a portfolio like that for 5 years. You're not gonna be losing money unless something really bad has happened. Then it doesn't care what our portfolios have done, if you know what I mean. And then Nvidia is not gonna save you either. So yeah, I hope it made some sense. But the main gist is like, again, never stop learning. Think all the time about. I like to visualize what's going to happen in some companies. It's like, okay, what could the news flow be over the next 1 or 2 years? What risks am I taking over the next 12 to or 6 to 24 months? What's the upside cases? And again, easy mistake is one where it's like, hey, we have a one target pre-discovery play here, and I'm like, hey, if they hit, it could go up 20 times. Forgetting that's like, yes, if they hit, it could, and that's still a big if. First, they need to make a discovery hole, and that, I mean, to make a somewhat of a discovery hole, that might be less than 5% chance, depending on the target. Then they need to prove that that discovery hole turns into a discovery. So they're going to be asking a lot of questions like, does the system extend 500 meters that way, 500 meters that way, 500 meters at depth? If so, yes, we might end up with a 20 bagger. But the 20 bagger is not going to happen on the first day. Again, if you buy with that in mind, it's like, oh, this might turn into a 20 bagger. It's like, keep in mind, it might be a 5% chance they actually make a discovery hole that anybody cares about and gives them more money so they can prove it up. So in a sense, and let's say they make a discovery hole, the stock probably might not go up more than 100%, depending on where it starts off at. Ramp Metal started off at such a low valuation and had such a good hit that it went up like 400 or 500% in the next 2 days. But that's super duper rare. Super duper rare. Happens 1 every 1,000 juniors or something. So you can take that to the bank. So in a sense, you're often, like I did when I started out. Well, first I actually went for beta, which was smart in hindsight. But it's like with the expiration plays, in my head I thought like, hey, there's a 50% chance this target is gonna hit, and nobody knows the actual. Maybe it wasn't such a bad bet after all, I don't know. Still, I bet too much, and in my head I was like, I have to be in before. That's the only way to get a 10 bagger. While that's completely wrong. You could have bought Philo after the discovery hole. I think you would have gotten a 10 bagger. You could have bought Great Bear after a discovery hole. That's some serious de-risking. Maybe the chance of success of proving up something really valuable jumped from, 3 to 5% to 15, 20%. And you only paid up 100%. So it's actually a lower risk, better risk reward proposition after the actual discovery hole, even when paying up 100%. So stuff like that. Again, I didn't start out with that stuff, but the more I thought about it, it's like, hey, when does actual risk show up and when does the reward show up? And figuring out now it feels stupid simple. It's like, yeah, when I think about it, when have I ever seen a maiden discovery go up, that's gonna end up becoming a 10 to 20 bagger, become a 10 to 20 bagger on the very next day after the discovery? No. My patented returns might have only been 100%. Then anybody could, with the information in hand, could just pay up 100% and had a much better case. So I might end up making more money than the other ones, but my investing strategy or speculative strategy is flawed because the risk reward doesn't make sense. So even if I made more money than anyone else, and I look smarter than anyone else, I'm gonna end up, if I keep doing that, I'm gonna end up losing my shirt down the line, because it's flawed risk management. The risk reward is not there, even though I look like a genius when I actually hit one. yeah, so consider me biased if I talk about any companies. Consider me biased if I talk about any companies that might be sponsored. Consider me twice biased. Never invest money you cannot afford to lose. I don't share your profits or your losses. Never buy a stock that you don't see the reason for owning. You know the drill. It's like, hey, diversify. Now is probably the best time. I mean, if let's put it like this: when the sector is at a low, the next big sector move is going to be up. So if you hold the sector, you're going to catch an up wave. Maybe not in the, I mean, yeah, major miners might also go up, but I don't see the merit of owning GDX personally. It's like, oh, how much do I expect to get out of Barrick? Yeah, if gold goes to 3,400 or 4,000, yeah, I'll make some. But they can shit the bed as well. And it's like, yeah, yeah, so that's not where I see risk reward. I actually think I have a higher quality portfolio than GDX. Maybe not a safer one in a sense because like you know that the GDX is never going to go away because that means that all gold mining would have stopped and that means the end of the world. But on a risk reward basis, if I have 30, let's say, different juniors and I put a lot of time and appreciating the potential margin of safety, maybe free optionality or at least very favorable high risk high reward situations, but I only take 1% positions in those. I think I have a much superior risk reward profile of my portfolio than a GDX. So to me, that would be too much of an opportunity cost to go with the majors. But again, that's me thinking about this stuff all the time, doing a lot of due diligence, have maybe more time in the market, have more experience, better at buying low and all that. So it's like every concept you can apply that makes sense is going to give you more and more higher and higher and more probable long-term return. So it's like now, if any time is the time to really do the work because we're in the junior space, we're near record undervalued levels. So the expected future returns are higher than it's probably been since, well, it was a bit higher in April, whatever, but we're still at low levels. So the entire sector on average has huge expected future potential, but it's still, you can have a wildly different risk profile. If somebody puts together 20 shitcoins, you might need to get lucky in terms of time. It needs to turn within the next 6 months, or maybe you're going to lose 30% from dilution, or some go bankrupt. Whereas if you pick the higher quality ones, yes, you might not have the highs of a shitco if the sector turned tomorrow, but you have a much smoother long-term viable investing strategy that, like me, you're going to have the minus 50% in your portfolio if you're not market timing, but you're going to get better and better and better. Maybe next time you'll have minus 40% in a big correction, maybe minus 30% and stuff like that. And with time, you're just going to, again, the compounding is just going to add up. So now it's not a time to be lazy is what I'm saying. I hope you appreciated this video. And as always, I mean, if you have comments or questions about some concepts or even stocks, even though I really don't comment on stocks that I don't know well, because it's like almost doing a disservice. I mean, there are some who's like have to have a comment on every stock, otherwise they, I guess, look like they don't know the sector or are not experts. I don't care about that. I'm only comfortable talking about stuff I understand and know. So keep that in mind. Thanks for listening. Bye.